I can, sure, go on.
Go ahead.
Good evening, everybody, and welcome to the October 2021 version of the Mid-Michigan Manifest Investing Roundtable. This is your host, Ken Cavullo. I'm a director with the Mid-Michigan chapter, and I'm joined by some good friends, Kim Butcher. Kim's down in Southern Florida right now, and she's been a Better Investing member for lots and lots of years. National teacher, just an all-around great stock picker. Mark Robertson from Rochester Hills, which is just south of where I live. And Mark's been helping the chapter out with this particular program now for close to 11 years. We have the baseball fanatic in the middle, Cy Lynch, and Cy is usually almost religious about coming and being with us every month, but he's going to take tonight off to watch the Braves try to beat the Astros. Cy is just a real dyed-in-the-wool Atlanta Braves fan, and I would imagine he's extremely excited about this. This is the first game of the World Series, right, Mark?
Yep, game one.
Game one.
And
then Hugh McManus, we're just not sure about Hugh, whether he'll be with us tonight or not. He pops in and pops out depending on his job. And there for a while with the pandemic, Hugh was a monthly visitor to the program. And now he's been snapped back by his company and traveling the world again, doing what he does for pharmaceutical companies. So we're going to have a good evening tonight. We'll have 3 stocks to talk about, and let's not waste any more time. We do have if you'll click once, Mark, we do have a disclaimer that everything we do tonight is an educational demonstration. Everything that we talk about is for illustrative purposes only. We're not endorsing any products. We're not recommending you purchase any products or you purchase any particular stocks. If we own any stocks that we're going to talk about in our personal portfolios, we'll try to remember to disclose that, but we're not always as good as we should be on that particular part of the drill. If you want email reminders about this event, you can send an email to my wife, ncavula1@comcast.net, and Natalie will put you on our guest list. If you haven't received material about the COVID cancellation conference 4 coming up on November 10th and 11th, drop Natalie a line and she'll send you a complete set of information, including links so you can register for that 4-class series. We've been doing those now. Each time we seem to move the Better Investing National Convention a little bit further down the road. We kind of have been filling in now with one of our COVID cancellation conferences, and we've been attracting really nice audiences. If you want a copy of tonight's slides, or if you have questions, Mark R. at manifestinvesting.com will be glad to send you slides or answer your questions. My email is kcavula1@comcast.net if you want to ask me a question. So let's get underway and move to our next slide. Our agenda is pretty set, and it's been pretty much the same for our entire history. We're going to look at the performance results of the portfolio that we've been putting together. We're going to manage that portfolio just a little bit. We do like to consider stocks for sale when certain criteria are met, and we'll talk about that a little bit as we go through that. You're going to hear presentations from myself on a stock called Wrap Technologies. You're going to hear from Kim on Cricket, and from Mark on Agilon Healthcare. We're not going to get Ollie from Cy. We hope that he'll bring that to us next month. And then we're going to take an audience poll, and we'll have open questions and answers. So I think it's time to get started if we possibly could. Let's look at what we've been trying to do ever since the inception of this particular program. We're trying to put together a portfolio that beats the market by 5 points over a long-term situation. As I've mentioned, we've been doing this for almost 11 years. And each time we come on the air, we compare the results of our tracking portfolio against the Wilshire 5000, which is a widely used index representing a large part of the total stock market. We'd love to be able to beat that performance by 5 or more points. We feel that is well within the spirit of the better investing goal of 15%. The market over years and years has done about 10. And when Mr. Nicholson back in the 40s and early 50s suggested 15, he really was suggesting trying to beat the market by 5 points if you could. We're also trying to push our accuracy up to around 60%. We've been hovering between 50 and 55% of stocks that are actually doing what we'd like them to do. And we'd like to push that accuracy to 60 if we possibly can. Mark, I'll let you take the next couple of slides and talk through them, okay?
Sure. So let's talk about how we have done. The rate of return on the portfolio, again, it's a tracking portfolio. So we basically keep track of every decision, whether it's a stock that is nominated or selected by a knight, a damsel, or the audience in the audience poll. And we basically put $1,000 into it and track it. And the overall performance of that collection of stocks, including all selling transactions and anything you can think of, just like you would with an investment club. But obviously, the tracking portfolio is a little different. It's, for one thing, it's got a lot more entries in it. Well, the rate of return on that collection of decisions is 18.5%. That tracks against a Wilshire 5000, again, matching or mirroring investments over that 11-year time frame of 14.6. So we have dipped down to the land of 3.9%. Now, that's not the end of the world. We'd love to be above the dotted red line. The dotted red line is basically the objective line for us and individual investors and investment clubs following these methods. And missing a little bit to the downside, again, is not the end of the world. But we would like to return back to where we were. A couple stocks have been kind of hard on us, Ardelyx being one. And there have been a couple others that have been a little bit of a disappointment here just in recent months. We were basically on fire. And Ken's right. We keep trickling up on the performance accuracy where we'd love to see 60% there. I think that might be a pipe dream. We seem to be hovering just above 50%. You can do just fine at 50%. 50% of your selections outperforming the general stock market. Yeah, you can do just fine.
Yeah, Mark, I've had to explain to a couple of people in the past couple of months that if this graph were to drop down to 0, that still would be 14.5% return for the portfolio. Mm-hmm. Remember, this scale on the left-hand side of the graph is talking about the number of points that you're exceeding the Wilshire 5000. So if you could just stay even with the market or beat it by 1 or 2%, you still have a stellar investment going, and you shouldn't be ashamed of that at all.
Yep. The graph itself is the picture of how much am I beating the market by. It's basically the answer to that question. All right, so let's go ahead. Here is the tracking portfolio. This happens to be the top 20 positions by position size. There's, again, I think there's probably about 80 positions in the total portfolio. So these are the top 20. You can actually see the entire listing at this public link if you want to go and take a look at them all and follow along. The legend up at the top is basically how many times the individual selections have been made. So in the case of Microsoft, it's now worth $78,600, as is shown here. It's actually been selected 5 times. That means that a total of $5,000 has been invested in Microsoft, and that has turned into $78,000. It's becoming a little dominant, Ken. quite a story at Microsoft. Other companies like Amazon is a 2-time selection. That's up to 23,000 now. And a lot of household names on there. Community favorites. Don't really have too many that are off the radar screen on that particular presentation there. All right, so that is the top 20. And here's basically what the whole portfolio adds up to. Right now, the average stock in our database, which is now up to almost 2,700 stocks, I'm tired. We've been adding quite a few with these small companies as we ratchet through them. 7.5% is the median projected annual return, or MyPAR. So we're always trying to stay 5 to 10% above that, and we're not there. I mean, looking at the report card, we've actually had quite a few stocks doing fairly well. Others are just kind of percolating along. The ones doing well are driving that number down. And quality is fine at 87. The growth is fine. We try to target approximately 12% for the growth. The PE is not exorbitant at 26. Yield is, that's basically a market average yield at about 1%. And the financial strength and EPS stability are just fine. So everything's in pretty good shape. We just simply have to keep adding higher return stocks. And then if we do get a selling opportunity with a low return candidate, I would really hope that many of our companies are very core, blue chip stalwarts. Even NVIDIA, which is a bit of a frisky company, I'd really, this is my personal opinion now, I would really like to see that PAR go 0 or even perhaps slightly negative before we release that one. The same is very much true with EPAM. EPAM is a poster child for up, straight, and parallel. So that's kind of the way I look at it, Ken. I don't see anything that's a screaming sell. Micron, go ahead.
We can continue that discussion all the way through Adobe, Schwab, Forward Air, and Paychex and Costco. Mark, we have all pretty much, maybe except Forward Air, we have a series of our core stocks right now that are down with fairly low pars, which translates into the fact that they're doing quite well in the market at the moment. It's been real good for some of these companies that have good, consistent growth in sales and in earnings.
Yeah, so I mean, some of the weakness in the portfolio has come from Ardelyx. Most of the people here are familiar with the Ardelyx story. That's definitely a speculative. I'm not even going to try to call it an investment. It's perhaps an investment only with a very, very long-term perspective. And that company basically went from $9 to $1 a share in about 15 minutes a couple months ago. So that Ardelyx was one of our largest positions, and that hurts a lot. A2 Milk is one that's been selected 2 or 3 times, and that has been misbehaving and mostly blaming China for a drop in consumption. That's an Australian, New Zealand company selling a different kind of milk. And then I've actually exchanged some correspondence with people who are worried about some of the opioid mentions and attributions in some of the literature. And it almost seems like some of it's going away. So maybe there is something a little bit shaky with that one. We probably should dig in a little bit deeper. Mercury Systems, probably emblematic of the type of thing that just happened to Lockheed. Lockheed came up a little bit short, blamed Afghanistan, and dropped 20% in a few minutes yesterday morning, or maybe that was this morning. I don't remember. This morning. So it's basically in that group, which is kind of sensitive to that type of news. Micron is down about 20%. Less than the market right now. No need to panic, but it'd be kind of nice to see that one recover. The other one on the good side is Universal Forest Products, Ken. I think that's one of yours. And
I really like this stock. I'm not surprised to see its RSI where it is. This stock's been on a real tear in the last 3 or 4 months. Yeah.
Yeah. Have you studied it recently? I mean, it's not.
I have not looked at it carefully. I'm not the stock watcher for it. It's one of our favorite stocks in one of my stock clubs, but I'm not the stock watcher. So I'm afraid I don't follow it as closely as I should.
Well, it's doesn't have a par less than 6, so I mean it's not on that list up at the top of the page, so it's still got some room to run according to our assessment of the business model. So again, I don't see anything screaming for action.
Yeah, we tried to get better, Mark, at not ending up with some of the best performing stocks only being picked once, but it just seems that no matter how good we try to get at that particular discipline, we still end up with the NVIDIAs and the Adobes of the world being picked just a single time, and meanwhile just just blowing themselves out of the water as far as price is concerned.
Yeah,
stock price is concerned.
That entry for Costco is a one-time selection. That's 10.
Right. I'm pretty sure that NVIDIA selection is a one-time selection as well.
Yeah, it's not up at the top of the page, so it's a one-timer.
Yeah.
So that did very well. It's done very well for us. So again, I wish there was something there that was something that could be taken off the table and celebrated and profits taken and redeployed into higher return stocks, but I'm not seeing it. So nothing there is terribly automatic. And this isn't that bad of a situation. But if Cy was here and not watching the Braves, he would probably insist that we dabble in something. All right. So with that, any other comments on the portfolio or anything else you think we should dig into, Ken?
No, but we're getting a couple folks asking if the session is being recorded. It is being recorded, folks, and it will be posted on the Manifest Investing YouTube channel sometime during the day tomorrow. Give us time to get the recording processed and get it up on the site, but it'll be there within 24 or 36 hours. I think Al is asking if we have a reverse pounce list to sell stocks in this portfolio. And I think you're looking at the process we use. If you want to call it reverse pounce, please feel free to do that. But these are the stocks with very low par that we tend to focus on. We don't tend to look very closely at stocks or try to find stocks in this large portfolio where the wheels are falling off. We kind of let par do that for us and signal when things are going. We do like to use guidelines for non-core stocks. We like to sell them when their par goes below the my par number. And for core stocks, and I think you might have heard us say that with the possible exception of Forward Air, these stocks may be and on assignment. That's on assignment ASGN, right, Mark?
That's correct, yes.
Yeah. With the possible exception of those two, I think the rest of the stocks are pretty much core on that list right there. So there's your answer. Okay.
Yeah, and for those of you that would like a little bit more detailed rundown, if you go to Manifest Investing and look for the Selling Better or Better Selling sessions, and I'll put a link to those discussions in the session notes on the forum. But that's where you can actually learn some of the guidelines that we have for, and we don't really have any what I would call automatic sells, but we have these nudges that nudge us into considering a sale.
Yeah, I'm getting two good questions, Mark. We might put on our list for our 20 questions class.
Ooh.
One of them, again, is to remind us about the difference between core and non-core. And basically, in our minds at least, and we've actually split the portfolio into a core group and a non-core group. The core group represents 75% of the portfolio, and it would be the classic better investing stocks, the up, straight, and parallel visual analysis of the stocks that you might say to yourself, that's really well behaved. And it takes something like a pandemic to really upset the consistency of its sales or of its earnings lines. Non-core, on the other hand, there's all kinds of good reasons for non-core. It could be a short history. It could be that there's very little analyst coverage of the stock. It could be that it's a turnaround play. There are a lot of different reasons for what we call non-core, and that represents somewhere between 20-25% of the portfolio. That whole concept of core and non-core goes all the way back to the beginning of Better Investing, when Mr. Nicholson suggested that besides the traditional investing that you needed to do for 3/4 of your portfolio, you might consider some non-traditional investing. And he went quite far with that idea. He mentioned bonds, he mentioned cash, he mentioned commodities, he mentioned a lot of different things which might constitute part of non-core holdings. I wouldn't be surprised that in today's market, Mr. Nicholson might even be looking very seriously at cryptocurrency and asking himself if there wasn't a place for that in a well-rounded portfolio, that you knew what you were doing, and it's not for beginners, this core non-core idea, but once you knew what you were doing and your portfolio was of a certain size, you could start to dabble in those ideas. So there's where those concepts come from. The other question, Mark, that might go on our list is PAR. Is that part of Better Investing, and how's it calculated? And Marco and Cindy, it's definitely part of Better Investing. It's right in section 5 on the stock selection guide, and it's the return calculated using the average PE from your own analysis coming from section 4. You know, in section 4, you set a high PE and a low PE going forward. And if you add those two together and divide by 2, you've actually set an average PE as well. Well, if you sell at the high PE, then section 5 tells you what that return might be, and they label it total return. If you sell close to the average PE, then the stock selection guide also labels that. We call it PAR, potential average return, potential annualized return using the average. There's all kinds of terms for it, but it's calculated exactly the same way as Better Investing does it. And it's a number that a lot of people think is probably more attainable when you make a sale than actually selling it at the high PE, which many times is quite difficult to do.
Okay. Are you ready to move on with stock presentations?
I think so, Mark.
And we'll pull up your own homemade slide here.
Okay, well, I can guarantee folks that I'm not losing my marbles. I'm not changing any of my thoughts about Better Investing, and I'm not changing any of my portfolios based on tonight's presentation. But I do like to dabble occasionally. I feel that my 30+ years of experience as an investor and the size of my portfolios gives me the right to dabble a little bit with some mad money. And it's not too often that I get an idea, and that's all this stock is. It's an idea right now, but that I get an idea that I become kind of excited about. The last time I was really excited about a stock idea was way back with Illumina, and that was a company that claimed they were going to reduce the time it took to sequence the human genome. And sure enough, they did exactly as they said they were going to do, and that was a home run for my portfolio. Tonight, we're going to take a look at Wrap Technologies. If you can go to the next slide, Mark.
Okay.
And Wrap Technology is a company out of Tempe, Arizona. It's a small company, and you get a rough idea. I took the thumbnail that comes with the Morningstar data, and I just reproduced that thumbnail there so you can get a general idea about what the company does. What I find so intriguing, and which I'll come back to in this presentation a couple times, is that not only is there an idea, but there's a patented idea, and it gives us alternatives for a problem that I think right now is a real problem in our society. Next slide. We're looking at a product that Wrap Technologies has patented and that is actually out in the real world selling to different customers. It's called the Bola Wrap, and essentially it's an old-fashioned bola. That's two weighted balls on the end of a string, and when you use the ejector, after aiming the bola towards a person that might be having a emotional problem or trying to get real physical with you or come charging towards you and deploying it, the bolas actually act as restraints. There's very little chance of any kind of permanent damage to the person. Even if the bolas should wrap around the neck, they don't wrap tightly enough to block the airway. And again, the ejector, the deployment tool, if you will, I don't want to call it a gun because it's not a gun, but all of these objects are patented, and those patents kind of protect the research that the company is making and the development of even more tools along this same line. Next slide, please, Mark. It's no question that police need better tools. They need more than just tasers and guns. Tasers, if you think back 10 or 15 years ago, were supposed to be the saving grace of police departments. And yet there were 10,081 deaths involving tasers since the year 2000. They're not completely harmless. And it's found that a taser, unlike physical restraints, will not necessarily drop some people and stop them from charging or moving forward towards the police officer or towards somebody that the other person might be attacking. Obviously, we've all heard about what guns can do, and we have the sad statistic that 810 people were killed by police in 2019. That's not a political statement, it's just a fact. And I think that policemen are some of the first people to tell you that if they didn't have to use a gun, they wouldn't use a gun. Next slide, Mark. Here's a nice graphic that comes from the Wrap website, and it shows you the ways that police officers can respond to people that are causing trouble. Starts with verbal commands and goes immediately to the Bola Wrap. The Bola Wrap is less intrusive than pepper spray or rubber bullets or beanbag bullets or tasers or obviously guns. And you would tend to use it less if in fact we had some ways to defuse situations before they became threatening to the police officer's life. Next slide. I did not know this fact on this black window here. The deputies respond 10 times a day to people experiencing serious mental health crises, which translates into roughly 3,000 responses annually for a normal deputy working in a police situation. Here's another statistic. Every 4 minutes in New York City, there's a call to restrain or to help an emotionally disturbed person in a situation that is not getting out of hand, but has the potential to get out of hand. You see that 1 in 4 fatal police encounters involve people that are emotionally or mentally disturbed. It's a problem. We've closed down a lot of the facilities that can help people. We've turned them out into the streets without a whole lot of support. And then we expect that when something happens, they're going to be rational when a police officer asks them to do something. And I just don't think that's the reality of the situation. Next slide, please. The Bola Wrap has a device. And again, every effort's being made not to call it a gun. It has a cartridge, one-time use, and it has accessories. So you can begin to see a business model developing. 14 US patents, 6 foreign patents, trademarks, 55 countries so far that have begun to use this particular device. It's only been on the market for about 2.5, 3 years. Next slide. The market size for non-lethal weapons in 2021 is probably close to $12 billion. You can see that there's probably 110 million different people that could take advantage of having such a tool on their belt, including 900,000 police officers and over 12 million police officers globally. It has potential for growth just based on the sheer magnitude of the number of folks that could conceivably carry this on their belt. Next slide. Right now, it's being used in 600 plus police agencies throughout the entire US. You can see dots all over the map. And the growth is in sales is pretty dramatic, and I'll show you that in just a moment. Next slide. Here is the growth. Like we said, it's only been around for 2.5, 3 years. It's been a publicly traded company for less than 4 years, but we're looking at extreme growth right here. But it's still an extremely small company. I make the point that Wrap Technologies has never made a profit. It has no earnings, and therefore it has no PE value. And therefore, you can't do an SSG of this company at this time. We're looking just at sales, and the analysts are telling us that they expect this company to move into profitability sometime near the end of 2022. That's about a year from now, or maybe at the beginning of 2023. In other words, my investment in this company, if I made it, would right now be investing on a hope, on a wish, and on a product which has never made any money up to this point. Next slide, please.
Mm-hmm.
One more slide, please.
I'm caught up in Bola Wrap here.
Okay. I'm showing you the manifest page for Wrap Technologies, and I'm making the disclaimer, and I'm hoping Mark would agree with everything that I wrote on top of this page, that estimates and calculations for Wrap are extremely difficult to make, And that's because, first of all, there aren't any profits. And second of all, it's followed by a relatively small group of analysts to begin with. This is definitely a speculative stock. And I can give you a fact that the stock is trading right now for less than $6 a share. You can see that the sales growth forecast going forward for Manifest is up above 90%. Obviously, that can't continue for very long, but for a small, early stage company like this one, the company was able to produce that kind of sales growth in a single quarter, and they have the possibility of producing that kind of sales growth for the next few quarters moving into that 5-year period that we've talked about. I'm not going to try to tell you this is a stock that you need to put in your portfolio, but if you have a little bit of mad money, if you have a portfolio where you're pretty confident about the majority of your investments and you have a little bit of money to play with at $5.73 a share, you might want to have a little bit of fun with Wrap Technologies. I'm going to end it with a short leash slide. This is the kind of stock that if you do buy it, you want to keep it on a real short leash because not only do you want to preserve capital if it turns around real quickly, but if you do make some money on it, you might want to preserve capital appreciation as well. I won't do an I told you so on any of the stocks that we've ever bought in the portfolio for the roundtable, but there are a few stocks that are hurting the roundtable right now that I put money into and then pulled money out of after I made 300 or 400% on them. I was happy to not be as greedy as we were in the roundtable to let that money ride. So if the stock does make a big move, then you might be hitting a home run. Either somebody will buy this small company or this small company will turn into a really healthy, thriving, fast-growing, medium-sized company. Again, however, keep it on a very short leash. Be very prudent about your decisions about these types of speculation. Thanks a lot, Mark.
Well, thank you. Now that I'm untied, yeah, I would actually encourage people in the audience to perhaps go back and take a look at what used to be the Taser company. It's now Axon, and look at its life cycle. I don't know how bumpy, but I'm sure it had plenty of speed bumps and hiccups along the way. And it just gives you an idea for the type of terrain that you could be headed for with a company like this. All right. Just a quick reminder that somebody asked a question in the green room. Do we provide recordings of these sessions? Yes, you can find all of the bull sessions, all of the roundtables, all of the successful investing conference sessions by going to YouTube. Just search on Manifest Investing. You'll find a page which displays this kind of stuff. All right.
I'd like to thank Dean for correcting me, Mark. I said there were 10,081 deaths from the Taser, and that should have read 1,081 deaths from the Taser.
Is the number wrong on our slide?
No, the number is correct on the slide.
Oh, read it wrong.
The old guy just read it wrong. That's all.
Oh, okay. Fair enough. And, you know, Ken, if I could go back and modify the first slide, I think I'd be tempted to give you a Hugh McManus face mask to be holding in your hand on the cover slide. He's usually the only one who brings these companies that don't have any E's. You know, nothing plotted in blue.
I should just have my wife take a picture of me holding my nose and send that to you, you know?
All right. Kim, are you still with us, or do we need to stop?
I am.
Oh, you are. Well, good. hopefully Mom's doing okay, and you can share with us your perspective on cricket. I learned a lot about this one when both you and Ken both mentioned this within the last 1 to 2 months. I got to admit, I must be some kind of a dinosaur. I hadn't heard of this company, and then I find all these people around me that are very much aware, if not hardcore users. So go ahead.
Well, this would probably be. I'm not being gender biased here, but you might have 90% women and 10% men. This is, if you go to any craft store at all, you have a circuit cutter. And as you can see on the screen here in the middle on the right-hand side, it's like a printer computer, and they have software products and technology that lets you make all kinds of crafty things. And the great many people who do it sell these products. And in selling these products, this is how they make their money, make a living, have a side hustle, or sometimes this is their primary source of income. And as this says here on the sign there, it says their mission is to help people lead creative lives. And it lets people make professional looking handmade goods that they can sell. The bottom line is the software, it lets people be, I used to do all kinds of knitting, crocheting, sewing. I hate to say it, I'm boring now. I just like doing stocks. But lets people do all this creative stuff. I know a couple of girls that, when I worked at the hospital, had one of these, and they would get together and they do all kinds of scrapbooking. And I don't have the patience anymore, and I'm not into that kind of crafting anymore. So it closed today at $27.59. This stock actually started trading March 24th of this year. It had been private for a long time, and they put it out there. One of the things that's really interesting when you think about it, this company has, it's got its own social community, and it's got 5.2 million followers, and 2.4 billion of the cricket users follow on TikTok. And they feel that they only have 4% of penetration of where they think that they can go. Now, they are in all the social media. You'll find the cricket on Facebook, Instagram, YouTube, Pinterest. With all those areas, they have lots of international growth. And this last quarter and second quarter 2021, year-over-year growth was 179%. So this company majorly grew because of the pandemic, because everybody was at home and they were trying to find something to do. And it's interesting that we always like to have a company that is international. Well, their top markets are Australia, France, Germany, and the UK. And they're expanding into Italy, Mexico, Spain, South Africa, Southeast Asia. And so here it is, we have an international company that would be in our portfolio, and it's a lot of cloud-based with these cricket machines able to get the software product from the web so that they can change things around. So if you were doing a side hustle of making shirts or labeling tumblers or doing things on the wall or making notepads, and I was even reading one of the new areas they're getting into is new materials, so they can make a 12-foot banner that you put on the wall of happy birthday and stuff like that. Next slide. And one of the things is create, all these slides are from their last quarter's earnings, and this is from their deck. Their next earnings report, I believe, is November the 10th. But if you think about it, creativity is universal. So ultimately, as I was saying, 179% of the revenue is international. And that really gives them a lot more areas to be able to grow. And 9.4% of that revenue was international. So think how much more that can keep growing. Next slide. These are their highlights, that they've got strong user acquisition and healthy engagement. It is a small cap, but they had a 42% year-over-year increase to 334 million, a 41% year-over-year increase of net income, 39% year-over-year increase of EBITDA. And what they believe is acquisition drives engagement, which drive sharing with others through all these social platforms. And they only have, only 5.4 million users, which was a 64% year-over-year growth. These users are engaged by using more and more product, and that rose 53%. And they have got a recurring revenue, since you can get on your phone, have an app so that you can look up things and buy it. And that subscription, the recurring revenue model, had an increase of 77% of year-over-year growth with only 1.8 million people. And considering how many people are in the world who do crafting, I think that's a huge amount of growth possible. And they feel that they're adding growth for their customers through the circuit access with their subscription, as I said, which is a recurring revenue model, which is one of those keywords that I like to use all the time. It lets you have access to 175,000 images with over 40% more than the second quarter of 2020. They've got hundreds of fonts, discounts, and priority to the circuit members. They also have the paid subscription with how much they had, and 33% of the user were paid subscriptions as of the end of the second quarter. Next slide. Their flywheel of how they think that they're going to be making money is the machines, which go to the subscriptions, the accessories and the materials you buy to go to the circuit cricket, and then it keeps going round and round. That their gross profit from their connected machines, it covers their customer acquisition costs. So I'm a crafty person, and I think this would be a great stock. Keep going. Next slide. When you think about it, the connected machines, the revenue grew 29% year over year. Subscriptions grew 111% year over year. Their accessories and materials, which they're always being innovative and adding new things, was up 40%. International revenue 179%, and that only represented 8.5% of total revenue and 46% of cash adjusted growth rate from 2014 to 2019, pre-pandemic. And I bet you that number is probably higher after. And as you can see on the graph here, the fourth quarter of 2020, they had a 42% year-over-year growth when we were in the height of the pandemic. These numbers in the last 2 quarters have stayed consistent, so they're keeping the people, the new members that they've had, and keeping them interested in using products. Next slide. And they've got a lot of engagement with their members. Over the last 90 days, they've had 53% year-over-year growth. You can see how that keeps continuing. The number of users has gone up 64% year-over-year, and their paid subscriptions have gone up 77% year-over-year growth. We've got lots of growth here, and ultimately, I think there's a lot more out there that they can get, because they feel by their presentation from their slides that they only have 4% of those people who are into crafts involved. That's a lot more out there that you could get. Next slide. And they're able to increase each user's monetization and how they're making money. So they're gradually creeping up. Accessories are consistent. Last quarter, you can see the second quarter of 2021 was, it went down a little bit. But overall, you're getting more users and they're using more product. Next slide. They've tried to make sure that they're reducing their costs to increase their gross margin. So they reduced by tariffs by shifting production from machines from China to Malaysia. They've got a higher mix of percentage of their revenue from subscriptions and the favorable mix within the accessories and materials. So they're specifically trying to watch what their margins are to make them improved, and they're watching what their costs are. And I think that's a good management team. Next slide. Now their balance sheet and their cash flow highlights. They've got $314 million of cash and cash equivalents, and they have $115 million of their credit line remains untapped. So if they have any supply chain issues for those accessories that people want to order, they're going to be able to migrate it and work around it and to invest for their future. And as of the cash flow used in operations, they had $54 million. So they're keeping cash and keeping flexible. That's always good. Next slide. Ultimately, looking forward, this is what the company believes. They are boosting new product launches and retail channel inventory catch-up. They've amplified summer seasonality and expected to extend this to the early fourth quarter. They're leaning into operational investments for user acquisition and monetization. And so far for the fiscal year 2021, the user added projection of 1.8 million plus people, which is equal to is what they did in last year. And when you think about it, as we as investors, we always know at Christmas time we get busy and we might do a lot of shopping. I imagine that all those people on Instagram and Pinterest with all those crafty projects will have a lot more items getting sold, which will affect this company. Next slide. Their long-term target model, which they had as a percentage of their revenue going forward, you can see where they wanted to have long-term growth of gross margins of 37 to 38%, R&D expense 7 to 8, S&M expense of 8 to 10%, G&A expense of 3 to 4, and EBITDA margin of 17 to 20%. I think these are all reasonable. Going forward, the management team will have to keep real watch on their costs, and they're already doing that now. So I think all of that looks great. Next slide. And doing the prove, in doing the prove numbers here, we obviously did this before the end of the day. The big thing you can look mark there in the middle, our projected annual return is 17.8%. 5-year sales growth of 28.7%. I think personally that's rather good. Now, one of the other things that we can do as investors, because this company just came out, you don't have the first proxy out, so I'd have to go back into all the S10s before it got out on the market as a stock to see what their management incentives are. But I'm really interested in this company, and I thought I'd bring forth to the round table because it's a buy in the zoning. It's a small cap, which you guys are really liking. They don't have that much of liabilities on hand of $360 million and cash on hand of $314. They can just about pay that off. So there you go, 17.8%. I hope you guys would consider this stock for your portfolio.
All right. Well, thanks, Kim. Interesting company. All right. Here's just a quick reminder. Ken mentioned this in the green room before we got started. We are going to do the conference. It's a series of 4 sessions, 4 classes on November 10th and 11th, including the final session will be a panel discussion of Let's Talk Stocks, picking some stocks by the distinguished panel that you see there. A pretty good track record here over the last few years. So we look forward to that. And then the 3 sessions will involve some small company stuff, the 20 questions about investing in general and investment clubs. And we are going to look a little bit at contests and what we learned from them. And again, some of that small company emphasis as part of that event. So November 10th and 11th, you can find registration details on Manifest Investing under events. And the Mid-Michigan chapter page has all of the information. and you can write to any one of us if you're more curious about it or if you have questions for us. All right, I'm going to head down a little bit different path than I usually do, and it's really kind of interesting. We're presenting some unusual companies tonight, certainly non-core, borderline speculative, and I just wanted to point out that it is an area that was endorsed for experienced investors by Mr. Nicholson. I personally witnessed Tom O'Hara basically make investments in these type of companies. You may remember the Irish pharmaceutical company Alon that got into all kinds of accounting trouble. Well, Tom was an accountant, so he was able to dig in a little bit and make some judgments about what he thought about that. But I'll never forget him basically hiding in the company library, sifting through the books, looking for information on Alon as he made that rather untraditional investment. And it's okay for that sort of thing. You just don't want to get carried away with it. Like everything, it's about balance. The company that I'm bringing tonight is kind of responsive to this situation. We mentioned the name Hugh McManus around here. Hugh was really on top of the 2008-2009 financial crisis, and called me many times, in some cases from overseas, to talk about this. And he brought this book by Charles Morris to the attention of our community. In fact, the one that I have, it's in my hand right now, is actually more of a maroon color, and it's the $1 Trillion Meltdown. And they actually had to release a second edition and up it to $2 Trillion Meltdown in the middle of that crisis as it unfolded. And Morris is a good writer, good historian, going back, looking at some cataclysmic, banking-related events over the decades, if not centuries. And he basically walked through all that kind of stuff. But towards the end, he rather abruptly shifted into a commentary on healthcare reform. And I remember being stunned. And I'm not a fan. I don't want to get too political here, Ken. Reel me in if you need to. I don't think that government is the answer to everything. And the chapter really kind of stopped me in my tracks. And what I've done here is just kind of quote for you guys. I'm not going to read this stuff to you. The challenges facing us in healthcare, they've got a long legacy. In fact, I tell the story of being in the public library in Wheaton, Illinois, reading through some financial analyst journals. And I'm reading along, and this was back during the time frame when Mrs. Clinton was First Lady and doing her testifying in Congress, and she had a very strong interest in making healthcare better in the United States. Whether you agree with her methods and means or not, she really did want healthcare to be better. And I'm sitting here in these stacks reading this dissertation on all the challenges facing us in healthcare, and I'm thinking, wow, this is very timely. It matches what's going on in the mid 1990s. And so I roll back to the opening of the book, and it was from the 1940s. So none of this stuff is new, and frankly, it's a lot of it is not solved. Ken and I were talking before we came on tonight about how antiquated and clunky some of the healthcare information systems still are to this day. And I have sisters that are nurses, and they basically agree that there's room for improvement, opportunities for better systems, and all that kind of stuff. That's still true today. And basically, he's talking about the healthcare basically still being a mess, and having tremendous room for improvement. And that leads to the company that I've gone ahead and selected. Let me tell you how I got there. As we go through the small company stuff, one of the people that we have been most impressed over the years is this guy by the name of Chris Jenner. Not that other Chris Jenner, but this Chris Jenner. And Chris has a heck of a track record. He ran the Health Sciences Fund at T. Rowe Price. You've heard us talk about him here before. And enormous, probably the best returns in the realm of investing over that 14-year period. And he has drifted off and formed a hedge fund, Rock Springs Capital Management, as is shown there with some of his partners. And he's just renowned for picking, medical device technology, very innovative healthcare type companies with solutions across the entire realm, technology and everything else with respect to healthcare. So his interest in stuff is something that we keep track of fairly closely. And what I want to draw to your attention is courtesy of Insider Monkey. Insider Monkey basically tracks the activities at a whole bunch of hedge funds and other institutional type investment vehicles. InsiderMonkey.com. It's free. You can actually buy a premium subscription, but you can get what I'm showing you here for free. And we just kind of like to keep track of people like Kris Jenner, who clearly knows what he's doing. And just take a look down the list of companies. I mean, you're going to recognize a number of those companies that Kris and Rock Springs are invested in. And what my attention is drawn to is the fact that he's got this new position in this company called Agilon Health, ticker symbol AGL, bought 7 million shares of this company, 5.6% of the total Rock Springs portfolio. They don't do this kind of stuff very often. So I'm kind of throwing caution to the wind. This is a very early stage company, but I'm kind of throwing caution to the wind and trying to catch the sales of Kris Jenner on something like this, because he clearly has a high degree of conviction about this particular company. So let's go ahead and talk about the company. Did I skip a page? I didn't. They basically are kind of trying to be responsive to that situation described by Charles Morris in that book. And this is a company where they're going in and attempting to very strategically cherry pick areas and patient populations and healthcare primary providers and doctors that are that they can actually leverage into trying to come up with a better solution, one which is basically focused more on health than sickness, is the way I would put it. As you read through their literature, their entire interest is on keeping, and principally, more elderly. I mean, elderly people have more money, so it's a good target. We also all like to feel better and remain healthy, so it's a good realm to be in. And obviously, the demographic is pretty strong here with respect to what's that opportunity look like going forward. And again, they want to focus on, as they say, keep us out of the hospital and certainly out of the morgue, but focus more on the health side of things versus the sickness. Obviously, they want to minimize the sickness, and so they try to become kind of a one-stop solution, including stuff as at least I think it can be very challenging for many, many people, including me, when it comes down to figuring out the benefits and the healthcare insurance coverage. And I sat with my parents. I am just aware of a number of people when it comes to managing Medicare and the supplements and all that stuff, and separate premium provider programs, and how that all fits together. Well, this company, Agilon, actually works to optimize that and use that for trying to achieve the best possible outcomes for the people that are participating in their programs. So that is kind of what it comes down to. I kind of throw it into this notion of trying to be responsive to all of these challenges. And this is kind of the way that they structurally map out what they are trying to do. Company has only been around since 2016, and they are Yeah, go ahead.
Mark, I have a real germane question, and maybe you can answer it for two of our people. What does PCP stand for in the third window, the third box there?
I could be wrong, but I'm pretty sure it's primary care provider.
Okay, that's what I wanted to guess, but I didn't want to guess it. Okay,
yeah,
thank you.
It kind of comes down to the primary care provider being the real quarterback that you're working with as an individual. As Wendy and I would be, working with this individual to, again, optimize the financial side. And then also, something else that was pointed out to me by a friend over dinner the other night, and I have witnessed this with my parents, taking this multitude of medications. Some of them are actually conflicting with each other, and they need to be optimized. Thankfully, my parents had a pharmacist that we was basically a family friend that helped us with that. But these are just some of the challenges faced in the challenge of healthcare, especially as you become older.
Our audience is wonderful, Mark, and we have Paul jumping in and suggesting it might also mean primary care physician.
It could, yeah. These guys use I think they use both phrases. So, like I said, I could be wrong about that. All right. So what these guys are doing strategically is they are picking certain metro locations. They started in, of all places, Hawaii and Ohio, and they have, Ohio is a pretty interesting situation operating out of Columbus with all the metro areas there. And they moved into the Austin area in Texas. And again, they're very much cherry picking. We can relate to the Michigan side of things here. Their objective and their targeting is going to be for the communities and the service providers that fit this profile in both Grand Rapids and the Traverse City area. So it's something worth watching. And these guys seem to be very meticulous and fairly strategic about how they're going to work. This has to be some of the stuff that Chris Jenner is seeing and reading between the lines and developing his expectations. So again, here's a look at the Ohio situation. Again, they become the quarterback or the point guard in dealing with the patients and whatever care is necessary. Again, focusing on the health versus the sickness side of things as best they can. And you can see on the far right that the geographic areas are mapped out there and seem to be progressing fairly nicely. So think of it almost as modules of activity and coming along pretty nicely in the areas that they have launched this effort. Okay, and here's their corporate overview. Again, a lot of buzzwords. One of the reasons I bring the company tonight is I want to basically raise my awareness of this type of company. I'll be looking for competitors. I think it's an area of tremendous opportunity for our country and for the people in our communities. And these guys we want these guys to succeed. And make the situation better for everybody involved. Again, a very quick and dirty track record. You can see that the results have been strong in 19 and 20. Here are the analyst expectations for top line sales. Pretty powerful situation there. We are looking at 30 to 40% growth rates in what they're doing with their controlled geographic expansion. You can see there's not a whole lot of price activity here to look at, just the one bar. But the key point and some of the stuff we've been talking about, in fact, I wanted to refer the audience to some of the effort that we have done here in the last month during our bull sessions. If you haven't, if you're not aware of and you haven't checked out the Brian Feraldi presentation on company life cycles and emerging and evolving companies, and how to think about PE ratios. And we like to believe that the projected return on value work that we do here is very complementary to that effort. We've done sessions on that also. Can be a little bit more useful. And in a situation like this, you can actually dig into and see that top line, see it unfolding. And then down below here, you can see that sometime in the not too distant future, the analyst community that follows this company is expecting that tipping point, that very key tipping point in the life cycle of a company when they go from negative earnings to positive earnings. And that is just down the road from their perspective. And the number that I'm using for a net margin is just simply based on looking at this trend and checking in at about a 10% number. That's where this number here comes from. 10% as something that seems to be viable and feasible. And we don't have a PE ratio, but we can check in on the fair value comparison using Morningstar. Morningstar, like many of us, is going to struggle with an early stage company, but at least it's a figure that suggests that this might be a little bit on sale. using the figures that we've thrown at it here, we do get a projected return of approximately 12% on the projected annual return. For an early stage company, it's probably even more important for these numbers to be factored in. You can see that the projected return on value is 7.3%, and these numbers are all pretty straightforward off of the analysis that we do in sections 1 and 2. And again, a fairly interesting story that I want to get closer to and dig in a little bit deeper. All right, so we will go ahead and throw that on the fire and track that one closely. As Ken was saying, all the warning signs that Ken was throwing up a few minutes ago, they still apply here too. Can I steal some of your signs, Ken?
All of them, Mark. Anything you want.
All right. Sai's not here tonight. We'll probably hear from. He tends to get stuck in a rut, and he'll bring back the same company a few times, so long as the characteristics are strong. And Ollie's is definitely one you might want to take a look at. It has been a community favorite. I have noted a number of investment clubs latching on to it. It was a Pat Donnelly selection for one of the successful investing webcasts last year. So this is not a stranger to many of us, but it might be worth digging into a little bit deeper. And with that, Ken, I think we can go to the poll.
And here we go, Mark. So we'd like you to vote, folks, with your mouse, or if you're on a tablet, with your finger, or with whatever tool you might use to get a mark into one of the circuits here. We did get a number of folks asking a question about what is it actually that you make with a cricket. And rather than try to answer that, I feel like I'm a sort of an expert, because my daughter is heavily into this whole concept of cricket and crafting and all that kind of stuff. I would urge you to go to a Michael's store or a Joann's store and look at the shelf space that they've devoted to this one tool, and then all of the accessories that go along with it. And you know that shelf space relates directly to how well those things are selling. And the amount of shelf space is just amazing in these craft stores that they're giving to this one product, and along with all the supplementary materials that you can buy to go with it. Originally, it was used to cut out intricate shapes and to make things where you could do stenciling and things like that, but it's advanced so much that I think to get a good picture, you need to just walk up and down the aisle and read a couple of the kits and find out what is happening with it.
I can see all these males out there in our audience out there scouting,
rolling their eyes. I know.
It's like the time when I was with that field of ladies. Well, actually, it was a bunch of guys holding a place in line at Coach for their spouses and significant others.
I'd love to get us up to 90% voting, folks. We're at 87%. How about a few of you, more of you, just throwing a vote in there? I'm going to kind of count to 10 in my mind and then close the poll down. And let's share the results. There we go. So Kim has convinced you to invest a little bit in cricket. And I think that we need our warning signs on all three of these stocks. They're all pretty new to the market. They're all pretty speculative. And please get the idea that there's a place for these in a portfolio once you know what you're doing. If you're a new investor, please stick with the good tried and true up, straight and parallel models. And we promise, or at least I promise, I'll come back to that model next month. I'm going to hide this now, Mark, and go on.
Okay, are we back
Uh,
displaying?
we're back live now, so go on, talk to the coming attractions.
All right, I guess the first thing coming up, it's something that we're very excited about, our selection show for our best small companies for 2022. And I'll give you a little bit of a tease here. At the start of that presentation, we talk about a company by the name of Mocon. I think the ticker symbol was, I don't remember. I think it's probably MOCO. And spend a few moments talking about how important that company was. Company had $25 million in revenue back, I want to say 20 years ago, but Chuck Allman of the Growth Stock Outlook was actually purchasing that all the way back to when it had like $1 million in sales. So it's going to rhyme with some of the stuff you saw here tonight. And using companies like Mocon, these small companies right in our backyards, Chuck was able to generate these massively successful returns. Mark Hulbert with the newsletter that keeps track of the best newsletters out there and the best forecasters, called Chuck Allman the best source of investing ideas over the last several decades, when you consider how effectively he managed risk. And so that's part of our show. And plus we'll have the rest of the companies and going to have some fun. We'll have the expected returns review. I'm trying to decide whether to do it on a Tuesday evening or a Saturday morning. And I may poll some of you that have been at past sessions to see what you would prefer there. That COVID cancellation conference number 4 is on the 10th and 11th, as we talked about here. And Ken, I'm fairly certain that we selected a couple days after Thanksgiving, November 30th, for the November roundtable. Did I get that right?
Absolutely. It's after Thanksgiving. Yeah, Mark.
Okay.
Okay. And I just want to shout out that Ann Kunias and I will be doing a ticker talk this coming Thursday. We have some pretty interesting topics chosen, and so if you have time to come to a ticker talk and listen to our presentations and our 5 and 5, we'd appreciate your attendance at that point as well.
Well, with that, I think we can settle in by the haystack and continue our hunt between now and Saturday morning, Ken.
Sounds good, Mark.
Make sure that your sorter hat's in good working condition as we approach that this weekend. But other than that, any closing thoughts?
Well, no, we do have a few questions we can cover after we close the website down, and I do have a hand in the air, and I'll recognize after we close the recording, okay?
Okay, so with that, thanks everybody, and we will stick around for some Q&A.